But to kick us off, on behalf of Betashares, we have our morning keynote speaker session led by Gleeson to discuss, amongst other things, the role of intelligent indexing in times of market uncertainty, just like we mentioned. Now, in his role as investment strategist at Betashares, Cameron spans all distribution channels, helping clients construct portfolios. Cameron brings experience from Macquarie, where he's responsible for structuring and managing their unlisted and listed products, as well as time at Bell Potter, JP Morgan's and Deloitte Consulting. His academic credentials span the country, with a Bachelor of Commerce from his home state of WA, so don't mention the footy to him. And then I presume he had to easternise that, translate that into a Masters of Commerce from the University of New South Wales. So please welcome Cameron.
Thank you, Jason. Thanks for those kind words. And thank you for Toby and David, Jenny and all the team at IMAP for having me here today. I've talked in this room a couple of times in IMAP conferences, and they're always, I think, really interesting. I enjoy listening to the other presenters and speakers. So today I'm going to talk to you a little bit about some of the things that Jason mentioned about, advisor and investor concern around market conditions, and talk a little bit about, the role of intelligent indexing. Now, at Betashares, we obviously are an ETF provider, and for a lot of you, the first thought is an ETF provider is all about passive, broad market beta exposure. I want to move a bit beyond that. We've been really well supported by the Australian investment professional landscape. We're over $30 billion worth of fund. We've got over $1 billion in our managed account solutions. So, last time I was up here, I was talking about satellite investing. I was talking about investing in thematics. Today, I'm going to go back to the core, because really where we look at the flows and talk to our clients, that is where people are focused. They're focused on building a strong core given uncertainty. I want to expand on how you might think about passive investing, and I want to perhaps challenge some of the notions of active management alpha and where alpha is generated, and talk about the role of both low-cost broad market beta as well as intelligent indexing, or smart beta in some cases, as a core portfolio. Now, just for context, I thought I'd sort of share a few points here. On this slide here, I show all the major asset classes that an Australian asset allocator is likely to consider when building a portfolio. And I show their performance in orange from the 2022 calendar year. And then for the first half of 2023, their performance shown in black. And I think, if you think about the headline of where we're at from a macro perspective, broadly we've had high inflation, persistent inflation, we've had central bank hiking throughout this period, and we've had some sort of US recession somewhere on the horizon, maybe. Now, despite the fact that those themes have sort of been running through that 18-month period, the performance of these asset classes has been somewhat confusing or divergent based on that macro view. So last year, the only real asset class that had positive returns was, of course, commodities. We saw oil in particular perform very well. As a result, Australian equities did quite well versus global equities. And this year, it's just flipped around, right? So bonds, obviously, last year had a shocker. On risk-adjusted returns have, in fact, done quite well. And global equities have led Australian equities. So given some of these movements and the backdrop, if you are managing a portfolio, you're starting assumptions as to the economic landscape. How do you think about allocating to a portfolio across asset classes? And of course, when we look at various markets, at a high level, we say, well, the US market this year up 16% for the first half of the year. Sounds like a great result. If you look under the hood, if you look at a breakdown of or attribution of the returns from the S&P 500, that line in orange shows the contribution or the return of what we know as the AI winners, or the Magnificent Seven. They've been referred to in the press. So these are large tech stocks that have really ridden this AI wave, and they're up about 16%. I mean, Nvidia is one of those, and they're up about 200%. And so that's been a really strong source of return for the overall market. Now, when we separate out the performance of those 7 names and their contribution to the 500, that's the grey line. That is basically the other 493 stocks. They're basically flat year to date. So that's kind of interesting when you're sort of thinking about that market. But it also leads to something else, which is a greater degree of concentration in the US equity market. What I'm showing here in grey in the background is the proportion, or the percentage, of the total S&P 500 market capitalisation weighted index, which sits in the top 5 names. And that's going back to the 70s. So in grey, we've seen that proportion in the top 5 names is currently sitting at around about a quarter in 5 stocks. So Apple's, about 7.3% of the overall 500. We haven't seen a degree of concentration like this for 50 years. You have to go back to the very early 70s since you've seen that concentration. And to give you a degree as to what we think about here is in terms of the way we build portfolios, we don't necessarily think, there's no specific rule that says that a market capitalization approach is the lowest risk. Look at Apple. They've had some issues with Chinese government potentially banning iPhones for government employees. If that stock's 7.5% of your overall portfolio and that's taken a hit, 20% of their revenues come from Greater China. There's some significant risk from having outsized single stock positions. Now, that orange line there, that is actually showing the performance of another investable universe that a lot of American investors will use, which is the S&P 500 Equal Weight Index. So it's the same 500 largest stocks, but rather than weighting by market cap, weighted by equal weights, or 0.2% in each stock. Where the orange line is going up, that's showing that the equal weight index is outperforming. Where it is going down, it's showing it's underperforming versus the market cap index. Now, obviously over the time frame, the orange line is increasing, but it's interesting to note the periods for where that orange line is jackknifing up the strongest. It's typically when concentration is already high and decumulating. So these are some sort of risks that we're thinking about, and thinking about that concentration in US equity markets, how you might look to offset that or play that. And just to give you an illustration of the overall outcomes, this isn't necessarily, if you're looking at the equal weight index as a potential exposure to replace a market cap weighted exposure in US equities, over the last 10 years, you may note that the equal weight index has in fact underperformed by a little bit. And that's due to the fact concentration has been rising. Over the long term, what we have seen is an equal weight approach will indeed outperform, or has indeed outperformed since common inception. So that's one approach beyond broad market beta that you might look to use. Another issue that allocators have to deal with is that most of you will operate under an SAA, and typically that will have a particular guideline for how much Australian equity exposure you will have. Now, in Australia versus other developed markets, we have by far the largest home country bias. So as shown on the chart there, around about, on average, 50% of our equities will be allocated to Australian equities. Now, if we think about this, from efficient market hypothesis, if you want, about 2% of the overall global market cap is Australian equities. So of that opportunity set, we're taking a very skewed subset in terms of the way we build our portfolio. And as you all know, our market's very cyclical. We've got a lot of cyclicals in terms of the financials, in mining. We've also got sectors like consumer discretionary, which in fact in Australia are more cyclical than global exposure. So very cyclical market. How do we think about building for that? How do we offset that within our portfolio? And then the final point to make, and I won't go through this in detail, is the jump in yields has meant something's changed in fixed income, and particularly relative to equities. When we think about relative valuations, and you might have read about, for example, the Australian equity market's dividend yield going forward is likely to fall to around about 4%, which is now below what you can get on a 10-year government bond. Fixed income's still been volatile though this year, right? So how do you think about that particular asset class? Now, sort of given all these challenges, I think it's important to go back to your sort of fundamentals. What are you looking to do when you're building a core portfolio? What do you want from investments that you put within your core? And the first thing will be, if you're operating under an SAA, is to fulfill that strategic asset allocation. And that's going to mean ensuring that the building blocks or the investments, whether they're funds, ETFs, or individual stocks, are going to retain their characteristics. They're not going to drift from, say, equities to cash on a subjective decision that you can't control. So you want to fulfill that SAA. And the second thing is you want to ensure that you can hold these investments for the long run. Because one of the things that we don't do well in this country when we're looking at performance is we don't necessarily manage and report on after-tax performance very well. And if you have a portfolio that you need to turn over when market conditions change, then you're going to incur transaction costs, which hurt you, but you're also going to possibly incur CGT implications. And the secret to building long-term wealth, in our view, is compounding over time. Things like CGT and transactions really hurt your ability to compound over, say, a 5-year time frame. Clearly, we need good net of fee value. Lastly, think about bringing in diversification, even within asset classes. I talked about Australian equities. What's some good global equities I could bring in to maybe offset that Australian equity exposure? So that's what we're looking for. And I won't spend too long on this, but if you were here last time, you would have heard Tim Edwards talk. He's from S&P Dow Jones. He was talking a bit about the research that they've done on looking at the entire peer group of active managers and comparing them to broad market benchmarks. And I think it's sort of well known and well publicised by S&P Jones that in most years the majority of active managers will underperform broad market benchmarks on a 1-year time horizon. Now, it's not true to say that in every year the majority of active managers will underperform the benchmark. So it's not true to say that. There will be various years when more active Australian equity managers indeed outperform the S&P 200. But that's the majority of cases. And we can see here, if we look at, say, for example, the orange line, this was going back to basically the close of December 2022. Last year we saw there's around about sort of just below 50% of active managers underperforming the S&P 200. One of the issues we see though is we tend to extend the time horizon. The proportion of remaining active managers that are outperforming tends to drop, and we see that that's obviously fallen pretty substantially, below 25% for the green line for Australian equity managers. So this is sort of important when thinking about your portfolio. It's obviously hard as an active manager indeed to beat the benchmark, and so you've got to be quite selective with the active managers you choose. Now, the other point to make, which Tim made, but I think is probably less well appreciated, is that in terms of active managers, if we look at the persistence of returns, there's quite a lot of rotation within active managers year on year or period to period. So if an active manager is outperforming in 1 year, there's a high degree of probability, and in some cases, effectively a coin flip chance that they are going to rotate from the top half of their peer group to the bottom half of their peer group. Well, what does that mean? If you are trying to select managers and you want to maintain strong performance, that might mean that you're increasing your turnover to rotate from one manager to another to select the next manager who's going to perform well in the next period. So this introduces some of that transaction cost and potential CGT. And it breaks some of the premises of that long-term core, what you're trying to aim for. So, costs will compound and hurt over the long term, and I think that explains a lot of the relative underperformance we see there. But also the issue around turnover is a real challenge. And so, I think maybe it's just worth, and I'm not saying you necessarily want to build your entire portfolio out of low-cost beta, but it's worth considering some allocation to low-cost beta, because typically that can act as something which is all-weather that you're holding for the long term, and then you're looking to perhaps complement that with something else, something beyond that broad market equity beta. And typically the question will then be, well, that first question was, well, do I want low-cost passive or do I want active? Which is going to give me something different, something unique. And most people, for that second bucket, will look for an active manager because there will be something about their investment process that resonates, that tells me I'm going to get something different. But we'd encourage you to do a bit of work, to have a think about how those returns are being generated, and perhaps how else that return time series can be proxied. So I'll give a couple of case studies. This is an example of a global equity manager who pursues a growth style bias. They were incredibly successful to the end of 2021. In grey, that shows their performance up to that period where growth was performing very well. So as a growth manager, you'd expect they were doing well when growth was doing well. Their benchmark is the MSCI World Index. They earn performance fees on beating that benchmark. And they won a lot of awards. They won lots of places in core portfolios. But when I look at their performance and I compare that to a passive, index-based approach, so for example, NDQ, which is our Betashares NASDAQ ETF, you can see there that return profile prior to the end of 2021. And it's sort of quite interesting because if you look at their portfolio, it does look a lot like the top part of the NASDAQ 100, but with some supersized bets in a couple of stock-specific names. Some of those that really paid off, like Tesla, for example. However, because they're earning such enormous performance fees over that period, the net result for the end investor was really no different to NDQ. And subsequent to that, those single stock bets introduced a lot of volatility, a lot of drawdown risk that we saw subsequent when growth fell out of fashion. Now this year, again, they're doing well. And I'm not necessarily saying don't use an active manager. But if you see an active manager and they're pursuing a particular style, have a look at seeing what else is out there, because a lower cost approach, as we can see, often approach with less concentration, can really benefit you in portfolios. There's also another aspect to this, which is what I've shown you are the investment returns. So effectively what's reported in Morningstar or what you'll see on a fund fact sheet. The chart here on the left-hand side shows you the returns to the end of May, because that's when I had the data up to, including the fund inflows and outflows data for that fund. So the returns were around about 16% per annum, which is a great result, right? Great result. On the right-hand side, we've got the fund investor return. Fund investor return. So this is the average return for each investor dollar invested in that fund. It's around about 1.3%. Stark. Nowhere near what the fund itself generated. Pretty disturbing. The manager itself made about $30 million worth of performance fees over the two bull rush period, that bull period over there. NDQ, the fund itself, up to that period, earned around about 18%. The fund investors also didn't do quite as well as the fund. They earned about 16%. A little bit less, but not so bad. So, this is actually an interesting example of what's known as the performance behaviour gap. And this has been written about a lot in behavioural finance. There's a lot of empirical research done, particularly in the US market, which has shown that investors actually tend to underperform the investments they invest in, which sounds counterintuitive. The issue is that we all are subject to biases like extrapolation bias. We tend to chase performance and we tend to redeem or sell out too soon. And it's been shown that on average, this gap, this performance gap, the difference between what the investment makes and what you invest, exists for both index funds and active funds. But the gap is typically higher for actively managed funds. It's also typically higher for high-cost funds. So this is something to think about when we're building portfolios, how investor behaviour impacts us. And one investment style that I think is very favourable to include is quality as an investment style. And that's because, when you had your clients come to you during COVID, and you probably had a few of them very nervous, some of them would have been looking to sell out of maybe all of their equity portfolio. How do you combat that? We know that we're not very good as humans at timing the market. How do we ensure that we remain invested, compound our wealth over time? Now, that loss aversion that investor was experiencing, that's hard to combat when they see their investment portfolio falling. But it's easier to come back and say, look, let's have a look at what you're actually holding. Have a look at the underlying companies. Talk about the names in there. Are they high quality companies? Have a look at the performance of that portfolio. Has that portfolio indeed, while it's been maybe down, has it outperformed broad market indices? The great thing about quality as an investment style is it typically benefits from a flight to quality, periods of market stress, and so you're likely to see outperformance during those drawdowns. That's going to be a really useful tool to talk to your clients about to ensure that they remain invested, remain allocated to the growth asset side of their portfolio when equities are cheap, because that's the last time when you obviously want to sell. Now, not only does quality obviously outperform in that drawdown period, it's been shown historically to outperform over the long run. So, really good thing to hold. And if you've, obviously a lot of you would have been looking through the earnings season, a lot of the themes that were talked through there were not just sort of gross margins, but net margins after financing costs and debt servicing and cash flow. So quality companies tend to perform very well on those metrics. And indeed, quality is a factor. While it had a bad year last year, it doesn't do well in an inflationary environment, it's had a very good year this year. So quality's done very well. And most investors, when they're looking to invest in quality, they will look for an active manager. It's that sort of default. Low cost, passive, that's what I'll do over there. For broad market beta, but I'll go active if I want something different. These are 5 of the leading global equity managers who pursue a quality style based on their factor profile. They're very large managers. Most of them are quite well known. The line in blue, so they're in grey, that's their performance over a 5-year period. In blue shows Misky World, and they're clearly giving you something different to the index. So that's tick, you're getting something different. You want that. And look, over the journey, most of them have indeed outperformed, which is great. But are they giving you something different? Again, I show a rules-based approach. So Betashares, QLTY, Betashares Global Quality Leaders. It tracks an index of quality companies. And if you look at the management cost differential, it's pretty substantial. Indeed, if you look at the way the portfolio is constructed, and I use the top 10 holdings to show a degree of concentration, we can see that the index indeed provides a lower degree of concentration of the top names because a lot of active managers in the quality space will pursue a high conviction approach, which can introduce some of that concentration risk. So when I'm thinking a little bit about this, and I'm thinking about, for example, using a active quality manager or a passive manager, what's some of the reasons why this may exist? Well, if I was pursuing that investment style, thinking through building that investment process, there's like over 1,500 companies globally in developed markets that I could choose from. I'm probably not going to do fundamental research on all of these companies. My first step's likely to be filtering that universe. So I'll filter out companies with a low ROE or perhaps with like bad cash flow, high financing costs. I'll filter out till I've got a short list of companies which are typically high quality. And while quality as a factor isn't universally defined, those characteristics are sort of broadly known and relatively consistent. And what I'd suggest is that that is where the majority of the investment returns are being derived, that first step of defining the universe. The second step of the hard work that goes into meeting management, doing research, looking at individual stocks, I question whether or not that necessarily is creating alpha in this particular case. Not necessarily the case for every single style or every single manager, but in this particular case. Because quality is something that leads itself very well to a rules-based approach. Now, to talk a little bit about fixed income, I just want to draw a couple of things out. And I do in these slides talk a little bit about how you think about building fixed income, but I won't go into that too much. I just want to share a few thoughts on fixed income in Australia. And the first thing is to look at how people typically think of our benchmark fixed income index in Australia, which is the Bloomberg Ausbond Composite Index. Now, this is basically a liability-weighted index of all fixed-rate bonds in Australia. And this shows the profile in terms of the sectors for a long period of time. And what we see there, if we look at that sort of, I guess I call it pastel yellow there, that's the corporate section of the Ausbond, or share of the Ausbond Composite. And that's sort of used to be around about a third of the overall index. Today, that's sitting at about 8% of the index because government bonds have been issued and that's increased their share of the overall index. You as an investor are not able to control the proportion of bonds issued by the government versus corporates. That's not something that's within your hands. So when you're looking to build a portfolio, it's not necessarily going to give you a stable investment with particular characteristics, whether it be income or duration that you're after. You can see how that duration has fluctuated over that time period, again, driven by the issuers. Now, looking also within the subset of bonds held, if we see, if we look through that index of bonds, it's going to hold all bonds in that index. And we know that while we think, within equities, broad market beta, most actors are, economically rational. Fixed income's an interesting market. There are actors that aren't necessarily acting in the way that you or I would think about bonds as an investment. So you've got central banks who will intervene in bond markets. And then you've got, for example, large banks that need to hold bonds for regulatory capital purposes. Now, typically they're going to be holding short-dated government securities. This is basically the subset of bonds which are issued by the Commonwealth Government in grey between 0 and 1 years to maturity, so treasury bonds. And I show that versus our Betashares high interest cash ETF, which just holds cash at bank accounts, but really that orange line could be any high interest cash sort of solution that you're using. And we can see that going back to the common sort of inception period, 2014. Now, the profile of these two is very similar. One reason why you hold fixed rate bonds is because they have duration and because in particular periods when your equities are selling off due to corporate earnings falling, you'll see, hopefully, you'll see that your government bonds will increase in valuations. But those bumps and movements are pretty immaterial in the grand scheme of things. It's pretty much like a cash exposure because 1 to 0 to 1 years treasuries, the duration's really short, right? Now, why would you look to hold something like these bonds when you can get more in cash? It's not an efficient investment. And why would you look to hold part of that in a portfolio where you're paying even a passive manager basis points to manage that as part of your overall bond portfolio? Doesn't necessarily make sense. And frankly, active managers in fixed income in Australia know this. And they know this, so they will look to under-allocate to this part of the market where they don't see value. But one thing that you might have read when you're talking to investors and managers about deriving alpha in fixed income is there are various ways to, as an active manager, add alpha in fixed income. Security selection will be potentially discussed as one. Now, I think security selection can play a role, particularly in, for example, a segment like high yield, but it's very difficult to add any alpha when looking to select issuers within investment-grade corporate bonds. And I show here a subset of our bonds. These are our bonds within one of our investment-grade corporate bond, fixed-rate bond ETFs. shown on the left-hand side, the performance of those bonds. These are all essentially roughly the same time to maturity and the same credit rating. So they've got very similar characteristics on those fronts. However, the issuers, as you can see, are from completely different industries. Some of these issuers they're issuing kangaroo bonds, they're Verizon, McDonald's, Barclays, there's obviously Coles and then an Australian infrastructure group. So they're very different industries. We've had a lot of events over this time period that have stressed property markets, for example. Banking has been stressed overseas. Yet the performance of those bonds, there's no dispersion there. And if you're an active manager looking to generate returns from your asset class, by security selection, you want dispersion. You want a difference between the best performing and the worst performing fund. I show there on the right-hand side, 3 of those issuers are listed their stock price performance, just to give you a bit of a flavour as to the degree to which that dispersion exists in equities. The opportunity, certainly the opportunity to generate outperformance is there in equities, but not necessarily so for high quality corporate bonds. And that's one of the issues that the active managers face when they're trying to generate returns in fixed income in Australia, investment grade fixed income. There's a quite a well-known study by AQR on this point. And what they did is they looked at fixed income managers in the States, and they looked at the returns those managers were generating in excess of the benchmarks that they were using. And they found that the returns generated were essentially driven by an overweight position in credit broadly. And I guess that's one of the points. As an active manager in fixed income, trading costs aren't insubstantial and you've got a management fee. To cover those, you're going to likely need to move up the credit spectrum. You're going to be overweight credit. And typically most active managers in Australia would be overweight credit. Now, I don't necessarily say that's a bad thing. It depends on what you need for your portfolio, right? Your particular circumstances might require that you need more than 8% credit, which is in the AusBond composite. But we need to be mindful of that particular portfolio positioning. And indeed, think about, is there another approach? Is there something else that can give you that similar profile, that overweight to credit, that doesn't have the same high fee load? So a couple of years ago, Bloomberg developed the Enhanced Composite Bond Index. This is an index, so Bloomberg owned the AusBond composite as it stands. That's an index series, it's very old index technology. They developed this because they wanted to provide a more investable universe. And they partnered with us to launch an ETF, OZBD. This index takes the same subset of bonds. It actually cuts out some of the segments that are essentially, like I would describe as almost uninvestable, like for example, 0 to 1 year. Then takes the remaining bonds, it's very similar to that overall AusBond composite, and then weights particular segments of the curve and sectors to provide a very similar risk profile, but an uplift in terms of the overall yield, which I can sort of demonstrate there over a long time period, around about 60 extra basis points of yield per annum. Now, if I compare the return of that fund and index, including fees, back to common inception with the 4 largest, what I call traditional fixed rate bond managers or funds in Australia, their returns are shown in grey. The blue shows the AusBond composite, and indeed some of these active managers have outperformed the AusBond composite over that time period. That upweight to credit will give you that over a long time period. But doing that in a lower cost, systematic basis, that index-based approach, deliberately tilting to credit and lowering your fees, doing it at a systematic basis, has resulted in far better outcomes. So look, broadly speaking, this is sort of outside the realm of what I talked about today. The shorter, sharper cycle means we think you need to sort of position across different styles of investment, whether it be value, quality, and alike. You also need to think about fixed income, and I'm sure a lot of you have really reevaluated what you hold in your fixed income portfolio because the characteristics have changed. And what you want from fixed income now might be different to what you're actually getting. We do think that there is a role for low-cost passive in your portfolio. There are characteristics of that are excellent. There's reasons why you want to hold over the long term low-cost passive. And we are not zealots for passive. Look, include active in your portfolio, but certainly consider index solutions that are lower cost, that are going to provide the same risk profile. So do your homework, look to see what there is out there that will replicate or indeed in some cases provide enhanced return on what a higher cost active manager is providing that particular asset class. Thank you very much.
Cameron, I have a question, which is you mentioned just towards the end that you'd worked with Bloomberg to commission a specific index? I mean, to what extent is the sort of passive universe becoming kind of index selective?
Yeah, look, I think it depends on asset classes. For certain asset classes, you're definitely looking to use effectively an off-the-shelf, say, market capitalization approach. So, for example, if I was looking for a broad market exposure, I'm likely to use sort of a market capitalization approach. But there are, nuances to certain markets, and fixed income in Australia is an example of that. And look, I mean, we talked to Bloomberg for a long period of time. They actually use us as a consultant in terms of their index technology here in Australia. And that's an area where we perhaps have some really strong expertise at Betashares. And it is an area where they felt they needed to evolve their product set. And so there was a particular need for that asset class for the index provider, and that sort of resulted in that discussion and the development of that index.
I thought a lot of people looking at the US bond markets and so on, and I know you got GGOV.
Yep.
I don't know what the yield is on that, but what yield are you generating, and is it tracking more or less the US bond market pricing?
Yeah, so GGOV is it's a 20-year plus Treasury bond index. So it's not the if you like the US aggregate. It's essentially designed to be a really efficient building block that's going to have longer duration than the overall US bond market. Because some asset allocators, they won't want to necessarily dedicate 10% of their portfolio to US bonds. They might want to dedicate 5%. So having a longer duration is really going to help you if you've got a view that you need that equity diversification, or you believe that rates are, bond yields are going to fall. I don't have it on the top of my head, but if the 10 years at 4.2, it'd be a little bit over 4.2. So that'd be the rough yield to maturity on the US Treasuries at the moment. So.